This conference will now be recorded.
All right, let's talk about retirement plans. You're going to get a few questions on this. I'll point out some areas that are very common. Some of the contribution limitations I doubt you'll get on the exam. The IRA you probably will, but the other programs you typically don't. So let's go ahead and get started. As far as general classifications for retirement, we have qualified and non-qualified programs. Qualified program, the most common ones you hear are like group sponsored programs like the 401k type of plan, okay, but also for individuals like IRAs. The plan must be filed and approved by the IRS. It's got to be in writing so people know that there's a plan. You cannot discriminate. Right? Anyone who's eligible must be allowed to participate in the program. The money that's set aside goes on a tax-deferred basis. Right? Your employer may actually make a contribution. If they do, it's going to be tax deductible for the employer. You can set aside your own money, and then typically when it comes out, it's fully taxable. Not in all cases, but in some, it's fully taxable. We'll get into those. In contrast, we have non-qualified programs. These are not filed and approved by the IRS. There are some guidelines that they have to follow, but they're not filed and they're not approved. The plan does have to be in writing, just like qualified programs, so people know that there's a plan. With a non-qualified program, you can actually discriminate as far as participation, like only executives or officers. The money that's set aside grows on a tax-deferred basis. But since it's only like an executive type of program, if the employer makes a contribution, it is not going to be tax deductible. Okay? So with respect to qualified programs, we'll start with that first. We have individual retirement accounts, or most commonly called or known as IRAs. We have fixed traditional IRA, which a lot of times the exam will say regular IRA. And then we have the Roth IRA. Okay? Know the concepts, know the difference. In a regular IRA, as an individual, you're going to make tax-deductible contributions into an account. It's going to grow on a tax-deferred basis, and then it becomes fully taxable when you take it out, typically at a later date, like retirement. You can actually set aside $6,000 a year. There are income limitations. If you make too much money, you cannot contribute. But there's also a catch-up provision. If you're over 50 years old, you can actually throw in another $1,000, so a total for $7,000 a year can be set aside. The Roth IRA says after-tax contribution. And so that $6,000, rather than reduce your taxes, pay the taxes first and then put the $6,000 in this account. The money grows on the tax-deferred growth, right? Interest compounds on interest. And then at retirement, it's tax-free distribution of the principal plus gains, okay? Again, $6,000 is the maximum annual contribution. There are some income limitations. If you make too much money, you cannot take advantage of these individual retirement accounts. With the Roth also, if you're over 50, you can throw in another $1,000. Okay. The premise behind a Roth is pay the taxes now, set this money aside, let it grow, and then use this money tax-free at retirement. Right? In either case, there's one thing you do need to know is you have to have a job. In order to contribute money to an individual retirement account, you can only set aside earned income, which is income from working. Okay. As far as the other qualified programs, we have two categories that they're kind of fall into, either defined contribution or defined benefit. It's kind of in the name. Defined contribution means you know exactly what's going into the program, right? So what's being put into the program is specifically defined, but you don't know what it could grow to or maybe not grow to, right? Now, a defined benefit, it's in the name also. So you don't know what's being set aside into the program, but when you retire, you know exactly what you're going to get when you leave, okay? So either you know what's going in, which is a defined contribution, or you know what's coming out of the program, that's a defined benefit plan. Now, in a defined contribution program, the employer may actually donate funds, right, or match whatever funds you put in. They can contribute. But a defined benefit plan, they have to. The employer is required to contribute. Otherwise, yes, there's typically no benefits. All right. So 401k versus 403b. These are elective salary deferral type programs. Right? Elective salary means you're electing to set portions of your income, pre-tax in an account, through your employer, let it grow on a tax-deferred basis, and then take it out at retirement, pay taxes on it then. So the difference between the two is 401k is for a for-profit company, and a 403b is for a non-profit company. A lot of times you'll see under Section 501c3 of the Internal Revenue Code. Those are revenue codes. In fact, 401k and 403b are also internal revenue codes that allow for these plans to exist. Both are pre-tax contributions. Both have an annual contribution limit. For 2020, it's $19,000. If you're over 50, you can throw in another $6,000. Right? Your 401k may have employer matching. 403b, a lot of times there is no matching. Right? Always think of, when you hear nonprofit 403b, think of preachers, teachers, doctors. Right? Preachers, churches, nonprofit, and teachers in hospitals that operate as nonprofit. Right? Now, they may match, they may not. It depends on the program. Okay. Now, when you take the money out at retirement, these are both fully taxable as ordinary income tax. 403b, sometimes you'll see it as a TSA, tax sheltered annuity, or TDA, tax deferred annuity. Okay. So think of it as a qualified program using an annuity as a funding mechanism. That's what that's about. Some other programs, these are defined contributions. Profit sharing. Well, we the company make a profit to give incentives for our employees to work a little harder. Why don't we share some of that profit with them? They weren't originally designed for retirement, although that's what they're being used for nowadays. And originally, they were only based on profitability, but we actually have some companies contributing to a profit sharing program when they don't make a profit. So it's kind of nice for the employees when the employer sets money aside. And yeah, it's based on the profits they made while you work there. So, employee stock ownership program. This is where some companies may set up a publicly traded company and allow you to purchase stock in the company you work for. Right? And sometimes a company may do some matching, like for every 5 shares you buy, they might give you 1 share for free. Okay. And so that's basically that. You just work for a company, and one of their retirement programs could be you're buying stock in the company you work for. All right. For self-employed, we have KEOs or SEPs, self-employed programs. They're basically the same. The difference is a KEO or HR-10, is named after Senator Keogh, by the way. It's actually regulated by IRS and ERISA, Employee Retirement Income Security Act. So ERISA requires a lot of documentation and disclosures, right? But if you're self-employed, this is a program that you can set aside for you and your eligible employees. Right? Maximum annual contribution is $56,000 a year. A self-employed program, or SEP, is kind of the same thing, right? Less paperwork, but the same $56,000 for self-employed individuals and their eligible employees, right? As part of the SEP family is a simple IRA. This is can be used for small corporations as long as there's no more than 100 employees. There is a required contribution for employers if they set up a simple IRA for employees. And this is really easy for a small company. If they have a few employees, to set up a retirement program. In a nutshell, you're setting up an IRA for each of your employees, and you're just funding it for them. That's, in a sense, what a simple IRA is all about. Okay? It's kind of nice that the employer has to match it, or has to contribute, I should say. ERISA, like I said, Employee Retirement Income Security Act, establishes pension equality. All right, make sure it's fair. It oversees the eligibility, make sure it's fair to the employees or the plan participants and their beneficiaries. All right, it also makes sure that the vesting schedules are fair. Okay, so because they do have to have some plans have to have vesting schedules, right? Where you have to put in some years of service in order to get your employer's full contribution if you leave too early. Okay? Some of them don't have vesting schedules. Some qualified programs for college savings. We have 2, 529 and a CESA, Coverdell Educational Savings Account. Both are after-tax contribution, both are tax-deferred growth, and then it's tax-free withdrawals for higher education. The difference is in a 529 plan, the maximum per year is $15,000, but the Coverdell, the maximum you can set aside per year is $2,000. Okay. There's more about the 529 plan. It's actually a state-run program, so each state may have a slightly different program as far as what you can use the money for. And you can do an accelerated gift. Right? So basically pay the first 5 years, 15,000 a year times 5, and you can just single premium start off this program. Right? But both are designed to help pay for higher education. Now, with these qualified programs, you really don't want to touch the money before 59 and a half. If you do, you're going to have to pay ordinary income tax, right, plus a 10% federal penalty for early withdrawal. Right? So you can avoid the 10% federal penalty if, unfortunately, you died. Right? Then it's paid out to your beneficiary. Right? It will be taxable as ordinary income tax, and then it's paid out. If you suffer a disability, right, and you need this to help cover your expenses, then you can waive the 10% federal penalty. You still have to pay normal taxes on it because all of this was pre-tax income set aside. A 72T distribution, this is kind of rare. It's more so on the securities exam versus the insurance exam. But if the program's been in place for about 5 years and you're at least 55 years of age or older, you can actually annuitize your qualified program or retirement program before 59 and a half. Okay, so maybe at age 55, you've had this program for a while, you want to take early retirement, you can annuitize it and take equal payments from then on. That's a 72T distribution. In the event you have medical expenses that exceed 7.5% of your adjusted gross income, then that's another situation where you can actually take money out of your qualified program and avoid the 10% federal penalty. Now, you still have to pay your ordinary income taxes typically, but there's no 10% federal penalty on that. Okay, and every once in a while you'll see that $10,000 can be used for a first-time home buyer. That's another one. I just didn't list that here. Okay. So you really don't want to dip in before 59 and a half, but you can't just sit on the money forever. By April 1st, following the year you turn 70 and a half, you need to take a distribution or begin a plan of distribution from this qualified program. If you do not, Uncle Sam is actually going to hit you with a 50% federal penalty on the minimum amount that you should have taken out. It's based on the RMD, required minimum distribution. Okay, they're not going to hit you with 50% penalty on the whole account. It's a 50% penalty on the minimum that you should have taken. That's all that is. Okay. So let me back that up. So basically, you have an 11-year window of opportunity to start taking money out of your qualified retirement program. Okay, don't dip in too early, but don't wait too late. Moving money between programs. Let's say you have a 401k with a company and you no longer work at the company, and you may not want to leave your money in the company that no longer wants you around, okay? Or you chose to leave, whatever it is, okay? So one of the things you can do is a rollover, right? And what your company's going to do is they're going to write you a check for the balance of your 401k account, and you have 60 days to roll it over to another pre-tax or qualified account, right? And you're doing this to avoid taxes, but you got to move the money within 60 days. Okay, otherwise it's fully taxable. If you're under 59 and a half, you have a 10% federal penalty also. It's doable, but some people, they don't move it over within the 60-day period, and then they have these heavy tax penalties. So the better route to go is doing a transfer. Okay, we don't make a check out to you. We make a check out to your receiving company. So you're going to set up an account, and then we'll make a check to that institution on your behalf. Since the money goes institution to institution, you don't have to worry about the 60-day rule. Right? And in both cases, you're moving money from one retirement program into another retirement program and avoiding taxes by doing so. In the real world, a lot of people mix up rollover versus transfer, but for the test world, know that rollover, your company cuts you a check, you've got 60 days to roll it over to another pre-tax account, and the transfer is institution to institution. Okay. Non-qualified programs. Very common is a deferred compensation. This is that executive benefit. Right? Remember, we can discriminate only executives or officers. If the employer makes a contribution, it's not tax deductible for the employer. But you, the employee, can make pre-tax contributions to this account. And again, it's designed to, grow till retirement and then supplement retirement income at that point in time. Okay. And an individual annuity actually falls under a non-qualified program. Although everyone could have it, not everybody does. So it's an individual benefit. You can either single premium buy it or make flexible payments, right? The money is after-tax money going in, tax-deferred growth, right? And then you're only taxed on the gains when you take the money out, typically at retirement, okay? And so, yeah, I'll have another annuity webinar to get to know more information about that, give you more understanding. All right, with that, thank you for watching this webinar. Good luck in your studies. Good luck on your exam.